Hey everyone, it's Daniel here from InfoVest. Hope you're all doing well. Just wanted to do a quick video talking about an article that was recently posted, just published today. And this comes out from Bloomberg. I'll put the link in the description for you to read up on it. But it basically talks about, the title says that Bank of England, BOE, to start asset sales in 2 weeks, exclude long-dated debt. So pretty funny, pretty interesting that you are having this back and forth flip-flop of the Bank of England, of these policymakers from both the fiscal side and the monetary policy side, looking to basically avoid some sort of implosion, avoid from some sort of massive drop in the 30-year bond prices or disruption in the financial sector. And you can see it from just a simple article like this. So here, if I scroll down in the article, it says the Bank of England will start its delayed bond sales early next month, but will initially exclude the long-dated debt at the heart of the recent market turmoil following the government's ill-fated fiscal plans. So very funny, very interesting. Bank of England coming out and first initially, before all this turmoil happened, first initially was going with the QT plans, going with the selling of bonds, to then stopping all of a sudden, and kind of blaming the government here with its fiscal plans and saying, hey, we're not the bad guys because we're raising rates and we're selling bonds and we're giving an ultimatum to the pension funds also, so don't blame us. It's the government who can't really control what they plan to do and say. And with their whole issue that is happening in the government in this turmoil, we're going to hold off on selling any bonds very early. So we're going to push selling the bonds early next month. And hey, guess what? We're going to exclude the long-dated bonds as well in our plan. So why such flip-flop, right? Why, just last week, the Bank of England giving the ultimatum to the pension funds saying that, hey, hurry up, do what you have to do, clean up your portfolios, and because we're not going to help you, we've stopped our QE, we're not going to keep buying bonds and whatnot, we're going to start our QT and clean up your mess, because we got to control this inflation problem, which I do agree with, which I do believe in. I'm not saying that they're lying about doing QT. They want to control inflation. But what's interesting is they're saying that, yet they're coming out, with, new, sources coming out with new information that Bank of England is looking to push on their tightening cycle, or they're going to exclude the long-dated bonds so it doesn't bring up the yields higher and causes any disruptions in the financial system. So when you hear that, it's kind of a softening tone that kind of puts downward pressure on those yields, and kind of makes you think that, what is the Bank of England trying to do? You're coming out and you're saying that you, yes, want to control inflation, but also coming out and saying that, maybe behind closed doors, helping banks and pension funds that, hey, don't worry, we're telling the media and everybody that we're doing our QT and tightening, but we will actually be helping you and buying bonds or doing whatever is needed to not exacerbate any pain in the financial markets and not cause an implosion of some sort anytime soon, right? So it's kind of like, a Bank of England with a two-face scenario, where one end it's saying something to the media, on the other end it's doing something else, right? Now I don't believe that the Bank of England wants to not do QT, right? I do believe they want to go ahead with QT. I do believe because they want to control inflation. Definitely that's their plan, but they're definitely more cautious because of the risks of implosion in the financial sector with the pension funds and the banking system. So they're taking it slow as they can, and giving kind of enough time and room and saying that, hey, we're not going to start off by selling these long dated bonds because that will affect you right away. So we're going to start the sale. And on top of that, it will also avoid a fire sale scenario where pension funds go out like crazy selling these bonds and causing those yields to move up, and again creates another problem again, right? So let me scroll down a little bit more in this article to a section where it says the new timetable. So sales were initially due to begin on October 3rd, but were delayed to October 31st. During the market disruption, the Bank of England is now pushing the start back by one more day to avoid a clash with the announcement of the government revamped fiscal program. The new sales plan is pragmatic, compromised by the Bank of England, allowing it to stick to its plan to unwind a mammoth balance sheet without risking the stability it has brought to the longer end of the market with the recent round of emergency purchases. So again, what it's just saying is that, it was initially planned October 3rd, but just pushing it out to now, let's say November, and that's when they'll start the balance sheet runoff, the QT, sales of the bonds, but not targeting the long end, just to give these funds enough room and so nothing implodes in the financial markets. So when we take a look at the British pound, the 30-year yields, sorry, not the pound, the UK 30-year government bonds, the yields on those bonds, as you know, on around September 27th, basically dropped heavily because of the intervention from the central bank. Then it rallied all the way back up to the same level where it was in September 27th. So that was around October 22nd. And then you had kind of some selling happening in the yields. So again, that's very good for the markets when you have the yields come down, especially for the UK. And this comes out from all the noise around the fiscal side of things. And once the fiscal announcement came out, the plan or the comment that was made on, I believe it was October 14th. Once it was confirmed, you had a jump in yields from about 4.4% to about 4.8%. So you had a jump in yields once that confirmation came in, and now you're seeing yields pull back all the way back down to about 4.28%. So the yields are coming off from those highs, and part of the selling of the yields, I would say, is again with the fiscal news, the plan that's coming out, the expectations of something to ease the markets. And on top of that, most importantly, this news today, which is bringing down yields lower, is the Bank of England not going hard on the selling of the long-dated bonds and pushing those yields higher and doing QT, I guess, slowly in a way, right? So what does this mean? Does this mean that the Bank of England have saved the day? Does this mean it's all over? Does this mean that we're not going to see some sort of disruption or for the yields to break above to a new high? In my humble opinion, I don't think this is avoidable. I think all of this kind of gimmick is just temporary until they start to realize that what they're doing right now, bringing and softening conditions, and if they continue to do that, it's not going to solve the main problem, which is inflation, right? So one way or another, they're giving the financial system, they're probably not just bluntly saying it out there in the media, but giving the pension funds, the financial sector, a window of opportunity, a timeline, a set time frame, and that window is going to shut eventually very soon. So they opened up the gates and saying that, hey, you've got to go through, and this is, and we've extended it a bit, but if you don't do what you're supposed to do, then we can't really help you. So I think it's just buying time for now until something maybe really breaks. And that we will know once we see where the 30-year yields are headed towards. If we start breaking that 5% or go above the 5 point, I think the highs were around 5.10%. So if we go above that and we start rallying higher and moving higher in yields and bond prices start to sell off, especially if inflation doesn't solve, especially if it's not being solved and we have more tensions in terms of the inflation side, then definitely those yields you should see to start to pick up, especially as part of the QT plan from the Bank of England is to start selling those long-dated bonds. They want to sell those long-dated bonds as part of their QT program in reducing their balance sheet. So they're not just gonna, I don't think, in my opinion, again, I could be wrong, but I don't think they're just not going to sit there and hold their hands and say, yeah, no problem, I'll just ease over and over and over again and forget inflation. No, they're going to give the small time frame, that small window, that small door to go through, extend it for some time, and then start to close that door. They'll start to close that door, and once they start to close that door, then that's when you can see and expect that, okay, the yields to move back higher, especially if Bank of England starts to sell those bonds, push those yields higher, and then do we get the kaboom moment? Do we get the implosion moment? Maybe, maybe not. Again, I can't tell you exactly when that moment's going to come. How is it going to come? But it will be interesting to watch, and I would highly recommend you watch the 30-year UK government bond yield to give you an idea if things are getting uglier or better off or not, right? So that's my opinion. Let me know what you guys think. Leave a comment below, subscribe to the channel, hit the like button and the bell icon to be notified on the next videos, and let me know what you think about this whole scenario of the Bank of England, the fiscal plans, and whether are we going to break that 5.10%, 5.10% in the bond yields, and what would it look like once we start breaking that level. So let me know, leave a comment below, and I'll see you guys around. Thanks, bye.